Yeah, hi, Hormaz. Great to be with you today, and thanks for your comments. Yeah, as you saw in the quarter four results, our volumes were roughly equivalent to the fourth quarter of last year, and so we were pleased to finally see the recovery in the market from a volume standpoint. Obviously, the headwinds on pricing continue to persist through quarter four. You know, to your question in terms of volumes looking forward, as we look to FY25, as we just guided this afternoon, we're expecting revenues to be up in the range of 4 to 8%, all of that being volume led. And so we are expecting a growth of volumes in the next year. And, you know, we believe that'll occur through the quarters, but the normalization of margins will happen mostly through the second half of the year.
You've highlighted in your investor presentation, Mike, that there are still some challenges in volume growth due to the excess supply that is coming in from China and the product bans in South Europe as well. Do you see that situation normalizing anytime soon?
Yeah, Hormaz. So, you know, as we report across two segments, the post-patent segment and then the differentiated and sustainable segment, and as you mentioned earlier, the growth was really strong in our differentiated and sustainable segment, which now represents about 35% of our business last year, and we believe will represent even more in the year forward. So that part of our business, which is high value to our grower customers and higher margins, we expect that's where we'll continue to see volume growth and margin expansion. In the post-patent segment, that'll continue to be a very competitive segment. We don't expect prices from China to increase as we go through next year. That being said, as we refresh our inventory, you know, we can be very competitive against the prices coming out of China. And so even in the post-patent segment, you know, especially as we get into Q3 and Q4 of next year, we believe margins will be normalizing in that segment as well.
Right. Mike, you've mentioned that Europe and rest of the world saw double-digit growth, but Europe is just around 10% of your business. What about Latin America? That is the major part of your top line as well, right? Almost 40% of your top line comes from Latin America. What is the situation on ground there? Because you've highlighted some challenges during this quarter as well.
Yeah, I would say Latin America is really a two-sided story. On the one side, Brazil continues to destock. We continue to see strong grower demand for our products and technologies, but distribution has continued to sell down inventory, and they want to replenish inventories really much closer into the season, so kind of a wait-and-watch approach. And, of course, that impacts kind of when we sell into the channel. Across the rest of Latin America, excluding Brazil, our business there has been very robust. We've seen really strong growth in countries like Mexico and Argentina, but really across Latin America. In this past year, we had a very strong business, both from a revenue and a margin perspective, and we would believe that that momentum is going to continue into next year. Europe, you asked a little bit about Europe, Hormaz, and I would just say, you know, we've got a very nice business in Europe. It was impacted a little bit last year by destocking and also wet weather as we came through the last quarter. We do see volumes regaining here even as we start this new year, and so we're expecting a strong year from Europe this upcoming season.
Right. Mike, I wanted to ask you about the debt as well. And you mentioned in your December quarter earnings call that you bring down the debt from 3.7 to 2.5. You've brought it down to 2.6. Do you see that figure trending downwards in FY25? Is there a number that you can guide for?
Yeah, yes, we do see it trending down in FY25. You know, our guidance for FY25 is that we'll generate between $300 and $400 million of free cash from operations, all of that going to debt pay down. We've also announced that we will do a rights issuance, which we would expect to happen sometime during quarter 2 or quarter 3, and that will also generate up to $500 million, and those proceeds will also be used to pay down debt. And finally, we're looking at other opportunities across our platforms in terms of raising capital. And if we do some of that, that will also go down to paying off debt. And so we're not guiding to an actual end-of-year net debt number, but we do have a clear line of sight to continuing to take down debt through FY25.
So would it be fair to say, considering the numbers that you have highlighted, that by the end of FY25, your debt would be below $2 billion? And since you mentioned other capital raising opportunities, what's on the anvil there?
Yeah, so again, we're not going to guide to an actual net debt at the end of the year. But again, if you take our current position, reduce the debt by $300 to $400 million from cash flow from operations, continue to delever through the rights issuance, and then any other opportunity that we can execute next year across the platforms, you could easily see yourself getting to that number that you referenced.
Final question, Mike, due to paucity of time, very quickly, you had, the reports about, we had reported last month about Advanta's IPO. Is there a timeline that you can share on that? Is that on the anvil going forward?
Yeah, no timeline on that. That wasn't our press release, and so somebody else has been speculating on that. Obviously, the Advanta business continues to perform very well. And again, we're going to look at opportunities across all the platforms to see where the best opportunity is to potentially raise capital to continue to pay down debt. So that would be one possible option, but there's other options that we're looking at as well.